COVID disruptions aside, it was another positive month in August, as share markets around the world took a leap higher. Strong earnings, particularly in developed markets, continued to reinforce the upward trend in share prices, while the Federal Reserve signalled that monetary support would unlikely be wound back with any great haste, which appeared to settle markets further. Shares in emerging markets also enjoyed a minor recovery, following the sharp pullback we saw in China last month. And bond yields remained relatively flat during August, reflecting uncertain growth and inflation outlooks across major economies. With the reporting season coming to an end, Australian companies have managed to post some really encouraging results. On the whole, earnings have rebounded quite strongly as a consequence of improved trading conditions in the second half of the year, with an above average number of companies increasing their profits and dividends over the last 12 months. The two standout sectors were miners, who were able to benefit from surging commodity prices, and the banks, who have gained from a booming home lending market in recent times. Inflationary fears in Australia eased somewhat during August, following the release of fairly weak wage growth data. Australia recorded just 1.7% for the 12-month period up until the end of June, which fell well below market expectations. The RBA has always maintained that faster wage growth will be the key factor in achieving persistent inflation. And at a meeting earlier this year, Governor Philip Lowe stated that for inflation to rise to levels consistent with its target range, it was likely that wage growth would need to sustainably rise above 3%. Now, for this to occur, Australia would need to experience a tight labour market for a significant period of time. And while unemployment numbers have been improving recently, the level of underemployment, being those who have jobs but would like to be working more hours, has started to trend upwards again. And with New South Wales and Victoria tipped to spend the better part of this quarter in lockdown, progress towards full employment is expected to worsen, which will only reduce the upward pressure on wage growth and inflation in upcoming periods. So what does this mean for investors? Well, until it starts to see low unemployment drive up wage growth, the RBA is likely to maintain its record low interest rates, which should continue to bode well for growth assets such as shares and property in the near term. Thank you for watching. For a more comprehensive market wrap, please head to the Capital Partners website.